Hi everyone, in today's video I want to give you the best ETF that you can buy for each one of the 11 sectors of the stock market. As you know, diversifying is one of the best strategies you can use if you want to reduce your risk and maximize your long-term returns. And investing in different sectors helps you avoid the risk of seeing your complete portfolio collapse all of a sudden because of a sector crisis. My name is Rick, and if you're new to this channel, don't forget to subscribe to it and drop me a like for the YouTube algorithm. And for this, thank you very much. Now, I'm going to give you one ETF for each sector, and on the bar here and on the description below, you're going to find all the chapters of this video so that if you don't want to see all the sectors, you can just skip to the one that you're interested in. And if you live outside of the USA and you don't have access to any of the ETFs that I mentioned, just drop me a comment below, let me know what sector you're interested in, which kind of broker app you use, and I'll tell you which ETF you can buy. Alright? So let's start. Coming in at number 11 is the communication services sector. And for this I choose the iShares Global Communication Services ETF. With 258 million in assets under management, a dividend yield of 3.23%, and an expense ratio of 0.4%, or $40 every $10,000 invested. Now, although this sector may sound boring, do you know which are the two biggest companies of the communication sector? They are Alphabet, the company that owns Google, and Meta, the company that most people know as Facebook. Now, tell me the truth, most likely you thought that these two companies belong to the technology sector, but in reality, they don't, at least in the stock market. Beside those, you have boring companies like Verizon and AT&T, as well as companies like Netflix or Walt Disney. Now, I'm not gonna lie to you, regardless of the ETF you choose, this sector performed terribly in the last 10 years. If you check the stock chart of IXP, you'll see two strong peaks in 2008 and in the end of 2021. But over the long term, there has been no great return. So except if you were incredibly lucky and you bought this ETF at the end of the 2008 crisis or at the beginning of the COVID pandemic, and you sold this ETF in the end of 2021, you probably wouldn't have enjoyed great returns in the last decade. As number 10 on my list, the Material Select Sector SPDR Fund XLB is by far the most popular ETF in the material sector. With $4.7 billion in assets under management, a dividend yield of 2.39%, and an expense ratio of 0.11%, or $11 every $10,000 invested. Like most other sectors, the material sector has seen a strong growth starting in March 2020, the outbreak of the COVID pandemic, followed by a strong decrease in 2022 that most probably hasn't reached the end. Over the last 10 years though, this ETF has delivered a yearly annualized return of 8.56%, meaning if you invested $10,000 10 years ago, you will now have $23,000, and this even takes into account the big price drop of this year. Coming in at number 9, I'll go with the utility sector, and in particular, the Utility Select Sector SPDR ETF. As of today, this ETF has $15.3 billion in assets under management, a dividend yield of 3.4%, and an expense ratio of 0.1%, or $10 annually for every $10,000 invested. For those of you who don't know, the utility sector includes public utilities like electricity, gas, and telephone service providers. Utilities ETFs can be used as defensive holdings in a declining market like the one that we're facing now. This is because of two reasons. First of all, because people are always gonna need gas, water, and electricity. And second, because prices of utilities usually tend to be controlled by a state utility commission, making this sector more stable than others. XLU has the highest amount of assets under management in the utility sector and delivers similar but slightly better results than the second best utility ETF, which is the Vanguard Utilities ETF, VPU. As of the end of September 2022, XLU delivered a return of 9.69% per year in the last 10 years, meaning if you invested $10,000 10 years ago, you would now have roughly $26,000. The largest holding is NextEra Energy at roughly 16%, followed by Southern Company and Duke Energy. If you consider the market turmoil that we're experiencing now, and the fact that this ETF and the utility sector have lost over 10% in the past month alone, then if you're interested in utilities, we might be heading into a suitable moment for buying into this. Alright, number 8 is the Fidelity MSCI Industrial ETF. With $589 million in assets under management, a trailing 12-month dividend yield of 1.6%, and a cheap expense ratio of 0.08%, or $8 annually for every $10,000 invested. Now, the industrial sector is vital to the global economy, so the recession of 2022 and other events like, for example, the Russian war in Ukraine have of course affected this sector, but it's not the same for all industrial stocks. For example, companies that operate in the defense and aerospace industry might benefit from the war, and companies that operate in waste management are usually recession-proof. The ETF is an industrial sector ETF, but still industrials cover around 92% of the holdings, with top 10 holdings including Union Pacific Corporation, Raytheon Technologies, and United Parcel Service. Like the other Fidelity ETFs, this was created in 2013, and in the last 9 years it grew with accumulated return of 73%, meaning $10,000 invested in the end of 2013 would be worth $17,300 today. Maybe not the greatest return like the other sectors that we'll see in this list, but still in a growing economy like the US, on the long term the industrial sector always delivers. Coming in at number 7, the real estate sector with the Vanguard Real Estate ETF. VNQ. This ETF has $39 billion in assets under management, a dividend yield of 2.96%, and an expense ratio of 0.12%, or $12 annually for every $10,000 invested. Who said that to invest in real estate, you need to buy real estate? Instead of buying real buildings or apartments, you can invest in the so-called REITs, real estate investment trusts, which are companies that own, operate, or finance real estate to generate income. Because REITs are required to pay out 90% of taxable income to the stakeholders, usually you buy into REITs in order to create a passive income source in the form of dividends. Launched in 2004, the Vanguard Real Estate ETF includes 167 stocks in all different REIT sectors like healthcare REITs, hotel and resort, industrial, and so on. Now, I have to say that I really like the real estate sector for different reasons, one being the generous dividends that this sector gives. And if you look at the past few years, the REIT funds have performed pretty well actually, but still I decided to put this ETF in position 7 because in 2021 we entered a phase of increasing interest rates. In particular, between January 2022 and today, the 30-year fixed rate mortgage average in the United States has skyrocketed from 3.22% to almost 7% in October 2022. Higher rates generally tend to decrease the value of properties and increase REIT borrowing costs, which of course negatively affect REIT profits and thus their stock prices. In fact, since the beginning of 2022, we've seen a strong drop in stock prices for REITs, including the Vanguard ETF. If you want to invest in real estate investment trusts, it might be smart to wait until the fall flattens and the interest rates stabilize, because I expect lower results from these companies in the near future. For the number 6, I'll go with the energy sector, and I'm gonna stay on Vanguard with the Vanguard Energy ETF. VDE. This ETF has $9.8 billion in assets under management, mostly in the oil and gas sector, a dividend yield of 3.52%, and an expense ratio of 0.1%, or $10 annually for every $10,000 invested. Now, I could have mentioned here the biggest energy ETF, the Energy Select Sector SPDR Fund, which has a whopping $39 billion in assets under management. But this ETF includes only 23 holdings, compared to the over 100 holdings of the Vanguard, making it much less diversified despite pretty much the same overall returns. With record oil and gas prices set early this year, the stock market in 2022 has been defined strongly by the energy sector. Some of the biggest names in oil companies like ExxonMobil or Chevron Corporation have seen significant gains in 2022. But the future of the energy stock prices is anyone's guess. Don't get fooled by the fact that Exxon has grown over 167% from the end of 2020, or that the same Vanguard Energy ETF had a similar result. Because if you check the long-term return of this sector, you notice that if you had invested your money exactly 10 years ago, or even in 2008 before the crisis, right now your gains would be close to zero. Now, I don't mean to frighten anyone, and in fact the energy sector remains one of the most influential sectors in the stock market. I just want to advise that a strong increase in energy stock prices is not an indication of future development. To conclude with this sector, if instead you're bullish on renewable energies, you might want to consider the iShares Global Clean Energy ETF. Coming in at number 5, the financial sector with the Fidelity MSCI Financials Index ETF, FNCL. With 1.4 billion in assets under management, a trailing 12-month dividend yield of 2.55%, and again, as many Fidelity ETFs, an extra cheap expense ratio of 0.08% or $8 annually for every $10,000 invested, FNCL offers exposure to 389 companies in the financial sector, with Berkshire Hathaway in pole position with 8.39% and JP Morgan following with 7.51%. But it's worth mentioning that the top 10 holdings weigh almost 40% of the total 389 companies. Investing in the financial sector is, in my opinion, not so easy. First of all, because the financial industry is not so exciting for most people. And second, because these companies produce their results using a lot of leverage, a lot of debt. So it's hard to interpret the results. If you decide to invest in an ETF in this sector, you're already going to have a great advantage compared to having to decide which financial institution or bank to invest in. Now, the Fidelity Fund was created in October 2013 and has seen steady growth since its inception, except for the start of the COVID pandemic in March 2020. If you invested $10,000 at the beginning, roughly 9 years ago, you now have $18,200. Coming in at number 4 for the consumer staples sector, I choose the First Trust Consumer Staples Alpha DEX Fund with $590 million in assets under management, a trailing 12-month dividend yield of 1.42%, and an expense ratio of 0.64%, or $64 annually for every $10,000 invested. For those of you who don't know, consumer staples products are the one that consumers keep buying regardless of their financial difficulties. This includes food and beverage, alcohol and tobacco, as well as household products. Since these types of goods are considered basic necessities, this sector tends to be more stable than others in bad economic times. Compared to other ETFs that seek broad market exposure, FXG aims to pick winners, and it does it using a quant-based model that weeds out underperforming stocks in the Russell 1000 using value and growth screeners. The top 10 holdings occupy around 40% of the portfolio and include names like Lamb Weston Holdings, Punch Limited, and Walgreens. Now, in case you don't like the high 0.64% expense ratio, or if you want to invest in more known companies, you can go for the Fidelity ETF, ticker FSTA, that had similar results, has a cheap 0.08% expense ratio, and includes companies like Procter & Gamble, Coca-Cola, Pepsi, Costco, and Walmart. Coming in at number 3, the Healthcare Select Sector SPDR ETF. With 37 billion in assets under management, a trailing 12-month dividend yield of 1.56%, and an expense ratio of only 0.1%, or $10 annually for every $10,000 invested. XLV tracks the Healthcare Select Sector Index, which only holds healthcare stocks found in the S&P 500. Now, the healthcare sector is one of the most resilient and defensive sectors in the stock market. It is the second largest sector by weight in the S&P 500 with 13.3%. Healthcare stocks have several traits that make them desirable investments, like evergreen demand that protects their margins and competitive advantage, lower volatility relative to the market, and higher than average dividend yields. This ETF offers names like United Health Group, Johnson & Johnson, Pfizer, and the sectors included are pharmaceuticals, healthcare, biotechnology, and life sciences. Beyond the biggest names, the fund offers a total of 64 companies, giving adequate distribution within the broad healthcare sector. The XLV has given an annualized return of 13.52% in the last 10 years, which translates into a great $36,700 for a $10,000 investment. Alright, number 2 is the Vanguard Consumer Discretionary ETF, VCR. With $4.7 billion in assets under management, a trailing 12-month dividend yield of 0.91%, and an expense ratio of 0.1%, or $10 annually for every $10,000 invested. Consumer discretionary includes companies that sell non-essential products like Amazon with 21.52%, Tesla with 16.45%, or McDonald's with 4.06%. I personally like the consumer discretionary sector because they're usually companies that we have something to do with in our lives. So it's kind of like you know them better than when you try to understand sectors like financials or materials. If you've read the book One Up on Wall Street by Peter Lynch, you know that he suggests to invest in companies that you know well. And in the book, he mentions a lot of consumer discretionary companies because if you think about it, we all know McDonald's, we all know Starbucks, we all know Nike. So we have a great advantage compared to investing in companies that we don't know the products of. Now, returning to the Vanguard ETF, a really cool fact is that the consumer discretionary sector has dropped over 30% year to date, meaning it could be a wonderful opportunity to invest in this sector now and enjoy great returns in the future. Alright, number one is my favorite sector, which is information technology. And for this, I choose the Technology Select Sector SPDR Fund, XLK. 36 billion in assets under management, a current dividend yield of 1.06%, and an expense ratio of 0.1% or $10 annually for every $10,000 invested, make this ETF the best choice when it comes to the information technology sector. Comparing this ETF with the other giants, the Vanguard Information Technology ETF, you can see that the performances are very similar. Although in the last 5 years, the SPDR is slightly better than the Vanguard. That's why it wins the pole position on my list. Over the last 10 years, this ETF delivered a crazy annualized yearly growth of 16.15%, meaning if you invested $10,000 10 years ago, you will now have $44,700 as a result of this investment. And this even taking into account that the sector dropped over 30% year to date. Now, I'm always really bullish on the technology sector, at least with a long-term side. Technology is by far the most innovative and profitable sector. And with the pace of technological evolution that we are seeing, I'm pretty confident that also in the future, technology will be the sector that will deliver the best results. But remember, since it's really hard to understand if a tech company in the future is going to grow or maybe disappear, I believe that choosing to invest in an ETF in the technology sector is a much better decision than risking your savings into single tech companies without knowing what's really going to happen to them. Alright, these were my 11 picks on sector ETFs ranked from 11 to 1. If I could help you in any way with this video, please drop me a like to help me with the YouTube algorithm. Thank you very much for it. And of course, consider subscribing to my channel if you enjoy this kind of content. If you want to check out other videos of mine about ETF, I will link to here on the screen. And of course, thank you very much for watching till the end. I hope you enjoyed it. I wish you a great evening and I'll see you in the next video. Ciao!